Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 14th of July. I'm Daniel Lam, your host for the podcast. So over the next 6 to 8 weeks, there will be much focus on the second quarter US earnings season. We see that, in general, companies will likely be beating the low bar, heavily managed second quarter earnings estimates. We're bullish on US major banks, and investors should also be adding to technology sectors on pullbacks. So the major banks will start reporting on the 15th of July. So according to LSEG IBES estimates, the second quarter earnings would grow by 5.8% year over year. So this consensus estimate has been lowered from 10.2% growth expected back at the beginning of April. That is setting a low hurdle for companies to be beating expectations. The two leading sectors are communication services and technology. The focus will be on companies' forward guidance and how it is influenced by consumer strength, the impact of tariffs, and AI investments. It will be critical to monitor the full year 2025 and 2026 earnings growth expectations, currently at 8.5% and 14% respectively. Now, as a reminder, we're overweight the financials, technology, and communication services sectors. So for financials, the major banks should be driving this earnings growth. We're expecting management to be upbeat on the US consumer given robust employment with contained provisions for credit losses. Now, the major banks have passed the Fed's annual stress test and proposed relaxations to the supplementary leverage ratio that would be freeing up additional capital. Of course, tariff uncertainties may dampen corporate loan demand, but deregulation allows major banks to pursue other growth opportunities, raise their dividends, and enhance share buybacks. Now, for the technology sector, we're expecting around 18% earnings growth in the second quarter and 17% in 2025 overall. AI investments continue to drive growth for semiconductors, and sovereign AI demand could offer further upside. We also expect software spending to be resilient, with C-suite mandates to be using AI tools, while the more complex reasoning models sustain cloud demand. The weak US dollar is also supportive of earnings as the sector generates 55% of revenue outside the US. Now, there are uncertainties in the second half tied to tariffs and the geopolitical landscape. That was what we talked about in our semiconductor podcast series last week. Most tech companies have a tariff exemption, but the US Section 232 investigation in the semiconductors is ongoing, with clarity in the coming weeks or months. A potential tariff on chips manufactured outside the US could lead to cautious guidance and a sector pullback. But we would see this as an opportunity to be adding exposure, as chip makers have the pricing power to pass on higher cost and global demand remaining strong. In terms of levels, investors can consider adding exposure in stages if the S&P 500 index pulls back to the 5,900 and the 5,700 levels. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.